Hey, everybody, and boy, happy Monday. Talk about a crazy weekend, a crazy trading day today. There's a lot to go over and a lot of developments, and this all has to do with some cracks that happened in the banking sector of the United States. So let's break this down step by step. You guys, of course, were hearing stories about Silicon Valley Bank and the fact that they did not have enough deposits on hand to meet the needs of their customers that were trying to make withdrawals. So let's talk about this. So, what really happened? Well, first of all, we have to understand how a bank makes money. When you go deposit money into a bank, that is a liability on the bank's books. Now, in order to entice you to make those deposits, they pay you a small amount of interest. Now, with your money, because of the laws we have in the US, they don't have to keep all of that money available for you to withdraw. They only have to keep roughly 10% of it. This is what's called a fractional reserve banking system. And listen, if the Fed didn't have this law in place, if the US didn't have this law in place, it would be very difficult for banks to make money, because if they had to keep 100% of your money, then they wouldn't be able to do things with that money so they can earn interest or earn an income. So what the bank does is they keep 10% as reserves, and then roughly the other 90% of it, they can do a few things with. One thing is they can go ahead and lend that out to customers. Maybe it's for car loans or different types of business loans. And typically that's going to be at higher rates, much higher rates than the amount they're paying you on the deposits. And then they can go ahead and make that spread or that arbitrage that exists between the two. The other thing they can do is they can invest it in very safe long-term bonds. Things like the 10-year treasury, things like, agency mortgage-backed security debt and things of that nature. So here's the problem that they ran into. Number one, you have, because the Fed has hiked so aggressively and they've inverted the yield curve, you have banks not making as much money as they once were. So an inverted yield curve means that you have short-term yields higher than long-term yields. That's why it's inverted. And when this happens, a lot of that profit that they were getting goes away because they have to pay you more on your deposits. But then on top of that, what you have happening here is you have customers out there that would normally put their money into banks to deposit them. Now they can get higher yield at other places. So what's an area where you can get 5% return now? Well, short-term treasuries. You can invest in a 6-month treasury and do way better than you could if you deposit your money at a bank. So now a lot of people taking money out of banks and then going ahead and depositing these things into things like treasuries, things like money market accounts. So this means that they have less cash on hand to begin with, less deposits that are coming in. And then specific to Silicon Valley Bank, boy, these are areas where they are doing a lot of lending and have a lot of customers in the Silicon Valley tech startup space. Well, what do we know that's happening in the tech space? It's slowing down. Of all the areas of the economy, this is one of the areas that's getting hardest hit by the Fed rate hikes and what's happening in the economy. You see most of the layoffs concentrated in this space. You see the tech sector, as far as in the stock market, not performing well. So these companies, naturally, they need some of the capital they put to this bank to keep the lights on, to keep operations going. And they can't go ahead and borrow as easily as they could before because since the Fed has hiked, it's more expensive for them to borrow. So you have all of these customers out there that are withdrawing money from Silicon Valley Bank. Now, to add insult to injury, what did you have happen a month ago? You had Mr. Kramer himself, the ultimate contrarian indicator, go on and say Silicon Valley Bank, SIVB, is a great investment. It's been beaten down 66%. The fears are overdone, and there's a good opportunity here to invest in it. And he got everybody, not only some people wrongly excited about it, but what he really did is he brought attention to the stock itself. When this happens, you have smart people out there that take a look at the financials. And when they look at the financials and they look under the hood, what do they see? Well, what they notice is that it looks like they have $12 billion of assets, meaning here's all the assets they have in the liabilities, and they have about 12 billion positive. But the problem is this. There was a law that was put into place, and this was back in 2008, where banks they didn't have to disclose unrealized losses on their long-term bond holdings that were agency debt out there because theoretically they're risk-free and they were assumed that they would be holding them to maturity. So if you take a look and you subtract out that provision, they were actually at a negative $3 billion in assets because of market movements. So let's explain this. When you have a bank that takes your deposits, one of the things I mentioned they can do is they can invest in long-term bonds that are very safe. But while the bond you buy at face value, and if you sell it at the end of maturity, you get that full face value back, while that's true, interest rate fluctuations in the market can impact the current value of it. Here's an example. Let's say they bought $10 billion of some Ginnie Mae agency mortgage-backed securities at 2%. Well, if all of a sudden in the going market, those rates are at 5%, then the $10 billion they spent on it, it's not worth the same amount as when they purchased it because you can buy the same amount of that debt in the current market, and instead of getting 2%, you're getting 5%. So they have to give you a big discount on that as far as the current value if you wanted to sell it and entice people to go ahead and buy that. Once again, it's because current rates have moved up so much in such a short period of time compared to when you bought it. So what's the problem that happens here? Well, you have, number one, people needing money. You have, number two, these banks out there, if they need to raise capital because they don't have enough when people are coming to withdraw it, they're having a hard time selling their assets because if they do, they're going to be selling them at a huge loss because interest rates gone up. Number three, you have people like Jim Cramer bringing attention to the stock, and then because people look under the hood that are smart and see that this bank's not in great financial shape, they start shorting it. Well, now you have a bunch of short sellers attacking the stock. Well, guess what? The bank's left in a very bad position because the bank can't sell common stock out there because who wants to buy it when it looks like they're in a weak financial position and you have all these short sellers attacking the heck out of the stock. But not only that, you now have this problem where when they're selling assets, they tried to sell $21 billion worth of their long duration bonds. They assumed $2 billion of losses on it. So as this gets worse, as the fever keeps building, people lose confidence. And then you have people advising them, hey, you need to withdraw all your money out of this bank. They're going to be insolvent. And this is the way that banks close. What was the cause of this? Straight out, it's the Federal Reserve looking in the rearview mirror, too tightly tightening and too quickly tightening and being too aggressive and not having the foresight to see all the pain that they're causing. Now, the Federal Reserve did something about this. They saw the writing on the wall. They said, well, we have SVB that's going under. We have Signature Bank in New York. Same thing. They're not able to come up with the deposits that they need for their customers. They said, we need to do something about it. So they acted quickly. And this happened. This was ruled on Sunday night that the Fed is going to provide liquidity to these banks. So the first thing they did is they said, we are going to guarantee all of the deposits that you have at the bank. And the reason why this was a problem beforehand, you might be saying, well, aren't some of these bank accounts insured? Well, yes, FDI insured accounts provide you with money up to $250,000 that you lost. But anything over $250,000, guess what? You're out of luck there. That's all it's insured up to. And many of these people out there have much more than that. If you look, 93% of the losses was actually above and beyond FDIC insured accounts, which means that if you're a business, it's not reasonable for you, if you have payroll and different things, to have your money all split up into 10 different accounts that are only up to the $250,000 insured limit. So it's literally an impractical impossibility for you to do so. So in this situation, the Fed steps in and says, we're going to guarantee the deposits for all customers. This quelled the markets, this calmed them down, and this then prevents people from running on other banks. But then what they also did is they opened up a facility where they basically said this, hey, if you're a bank and you're coming under pressure and you need money, we will allow you to sell your bonds, trade your bonds into the Federal Reserve. And when you do this, we're not going to give you what the current market rate is, so you have to take losses on it, but rather we're going to give you the full face value of that bond, meaning whatever you paid for it, we're going to give you that money, even though rates have gone up And even though in the current market, they're worth a lot less. So as a result of this, we saw a little relief rally in the market. We saw the bond market really like this and move lower as there's a big flight to quality. But I think probably the most interesting development is you see Bitcoin up about 9% because clearly the Fed doesn't know what they're doing out there. And the Fed making mistake after mistake after mistake. And then there's serious cracks in the banking system. So people clearly seeing, you know what? Maybe this decentralized world of cryptocurrencies and specifically of Bitcoin is a good idea because we don't have the risk of all this inflation. We don't have the risk of this centralized finance system where you have the Fed that's doing a poor job of managing our monetary system. And you also don't have the risk of banks because clearly banks are showing a lot of weakness out there. This fractional reserve system, listen, to some degree, you need to have something like this for our current financial system to work, but clearly it has a lot of inherent weakness there. And boy, oh boy, how scary of a prospect is it that you can go to the bank and if too many people are coming to withdraw their money at the same time, you guys are out of luck and you don't have your money, right? That's something that most people can't even fathom, but this is bringing it to light and bringing it to reality. So conversely, how does a system like Bitcoin sound where there's no counterparty risk there with these third parties, meaning you don't have banks, you don't have a Federal Reserve, it runs on a protocol, and the supply is fixed. The supply is not only 21 million, but the supply coming to market every day is fixed. And we know that that gets cut in half every 4 years with the halving cycle. Instead of having the Federal Reserve out there making decisions, it's on a predetermined protocol. I think a lot of people, in lieu of this news, in lieu of this fear out there, are starting to see the prospects, especially now, in something like Bitcoin. But what does the Fed do going forward here? Because the Fed, this is just the beginning here, team. I hope that we don't have anything escalate further, but clearly this is showing the current weakness we have in the banking sector. But what happens if things get worse? What happens if you still see this loss of confidence? What's the Fed going to do at their March 22nd meeting that's going to be coming up in about 9 days or so? Well, before all this happened, the talk was, is the Fed going to hike 25 or 50 basis points? Well, now the talk is the Fed going to hike 0? Or is the Fed going to cut rates? Or is the Fed going to have to do some additional quantitative easing? This facility, they said that it wasn't a bailout because they are just buying existing bonds that these banks have at the face value of them. They're not, paying them above what the face value is. However, they are paying more than they're worth in the current market. Now, theoretically, if the Fed holds those on to maturity, they will be made whole. But, while you could consider this alone, it is definitely a form of quantitative easing. And the Fed really messed this up. The Fed thought inflation was going to be transitory. They let things get way too hot. And now the Fed, afraid to make another mistake, is in the position where they're trying to kill the economy. But what does the Fed do? They hike until something breaks. This is exactly what we're seeing here today, team. So at the March 22nd meeting, it's going to be interesting. If I had to bet on it, I'd say they're definitely not hiking rates. And I think that there's a chance that they're actually going to cut rates because they're going to be fearful that this could happen not just at these two, regional banks, but that it could spread to others. And remember, they came out and said we would do a $25 billion facility. So theoretically, if this quells the concerns out there, you may not have any additional situations like this, but people are going to poke around. People are going to try to look at other banks that could be susceptible to weakness, take a look at their balance sheets, which is public information, and you're going to have situations, I think, where you could see some short sellers start really attacking banks and financials, and it's possible that you could see this spread. And remember, the Fed only committed so far to $25 billion worth of this facility, but it may not be enough. So we'll have to wait and see here, team. But in any case, I think that although you saw a little bit of a pop in the stock market, it gave back most of those gains towards the end of the day. But although you did see that happening, I think this just spells weakness for the overall stock market. But on the other hand of things, I think this makes a really strong case for cryptocurrency and specifically Bitcoin. If you didn't like it before, I tell you what, you should like it a lot more now because you're seeing issues with centralized finance systems. You're seeing issues with the U.S. banking system. You're seeing issues with the Federal Reserve, Remember, this country continues to deficit spend. This situation can't help things, okay? And you continue to see inflation just go up over time. It's very rarely that you see inflation actually move lower. It's just going up at a slower pace. So over time, what does that mean? The cost of goods and services rises and your dollar gets devalued. Why do you think you continue to see wages go up every single year? Why do you continue to see, things cost more? If you go back to when your parents went to the movies, it might have been a nickel. I just went to the movies this weekend. It was $15, $17 to see a movie. Same length, okay? So this is what happens in a system like ours where you continue to have deficit spending, you continue to have debts grow, and the only way to get out of that debt is to continue to add more debt. Because the only way to really get out of it would be to have a great reset. And what elected official would want to be responsible for that? Heck, if they ran on that premise, they wouldn't get hired. They would not get elected. I don't see this ever ending, at least unless you saw a big reset like this. So with that being said, I think Bitcoin looks better now than it ever has. And if you just look, Bitcoin up about 9% today, up about 25% just over the last 3 days. But in relative terms, I think it's still pretty cheap. Remember, it wasn't too long ago, it was at 69,000, a little over a year ago, right? Well, people thought it was very attractive then, just as retail investors always do. When it's at 69,000, there's all kinds of people that want to get involved because they think it's going to 100 to 200K. Now that it's down 65% from the all-time high, you got people out there that are scared, right? Now, I'm not guaranteeing you or saying that the price can't go lower from here, but in relative terms, it's at a 65% discount from the all-time high, and I think the prospects of it are sexier than ever.